Well, good afternoon. Thanks for joining us for this webinar. Does tech still belong in client portfolios? It has been one heck of a year, and it seems that we're ending the year on a down note as well. We know how bad the stock market has done overall year to date. We know that tech has done, frankly, even worse. And last week we had the FTX blow up in the crypto sector. So we need to answer this fundamental question: does tech still belong in client portfolios? And to help us figure that out, I'm really happy to be joined on this webinar by Ryan McCormack. Ryan is the Senior Factor and Core Equity ETF Strategist for Invesco. Ryan, thanks for joining us on this program.
Thanks for having me, Rick. Appreciate it.
Ryan's been in this space for more years than I think either one of us want to recount, with a long track record at a variety of firms, not just Invesco, but also at Oppenheimer and Merrill, and a degree in economics from Johns Hopkins. Ryan, tell us a little bit about Invesco. It's a very familiar name in financial circles, but tell us about the firm.
Yeah, so I think Invesco broadly is a very well diversified asset manager. Well over $1 trillion in assets under management. We operate with well over 2 million clients, with offices in more than 20 countries, and really we kind of stand by the fact that we seek to be the most client-centric firm. Not only through the products and services that we offer, but also our team here. From an advisor standpoint, really starts with our team of senior advisor consultants. They're in the field. They're out there in the wealth management space, the RIA space, the private client space, the retirement space. And this is a very well-seasoned sales force, very well tenured, and a ton of resources at their disposal, which flows down to things like the ETF team, a number of specialists that are out there also in the field, working hand in hand with those consultants, the investment teams that have the autonomy to sort of find opportunity, run money in their space as they see fit, and then kind of our model portfolio team from Invesco Solutions, where deep portfolio analysis, looking at portfolio X-rays of financial advisors' models, as well as helping with model portfolio construction. And this sort of spans across a number of different products, right? We're in the alt space. We're the 8th largest manager of alternative assets globally. The ETF suite, we're the 4th largest ETF provider globally. China, we're the #1 ranked China onshore manager. Our solutions business has grown to well over $70 billion, representing over 30% of our institutional pipeline. So, we are in the markets where we're seeing growth. We seek to provide ample choosing for advisors on how they run their business and what would make their business most efficient, and we seek to be to provide those opportunities and investment vehicles where appropriate.
And that sets a really good stage for this conversation. And by the way, we invite you to ask your questions. Many of the advisors who are watching this live event sent in questions in advance. We're going to bring yours up during the conversation, and you can ask questions on the fly. Go to your Q&A button here on Zoom and type those in, and we'll tackle as many of them as we possibly can during this next hour. You just went through, I think, all the basics about Invesco. As you mentioned, the 4th largest ETF provider in the industry internationally. But what is it exactly, Ryan? We're going to get to the big tech question, but I want to just set the foundation for everybody about Invesco's role in the ETF community. What is it that Invesco ETFs are predominantly known for?
Well, off the bat, I would have to say QQQ. It's the fund that I'm the lead strategist for. We like to joke that it probably belongs on the Mount Rushmore of ETFs, with well over 20 years of live track record. It's the 5th largest ETF listed. It's the 2nd most actively traded. It is the official ETF of the NCAA, with Invesco as the official asset manager of the NCAA. I challenge people to go, more than 20 minutes or so on CNBC without seeing a QQQ commercial. So I think right off the bat, the easy answer is most people know us for QQQ. But beyond that, I think we've had a number of iterations, expansions to the QQQ family that are gaining notoriety. QQQM, which is the Nasdaq 100 ETF, along with the NASDAQ Next Generation ETF, launched 2 years ago. Some ESG versions of the Qs family last year, and most recently, kind of a small cap patent-based portfolio launching. But outside of that, I think Invesco broadly is known, and the majority of our ETFs are not your traditional bulk beta, right? Whatever buzzword you want to use, smart beta, single factor. In our case, we have a dynamic multi-factor suite, but really we're looking at alternatively weighted ETFs, things that aren't necessarily weighted by market cap. And in bringing the first smart beta ETF to the market way back nearly 20 years ago, RSP, the S&P 500 equal weight ETF, kind of got Invesco, and by then PowerShares, kind of the start within this smart beta and alternatively weighted world. So, although QQQ probably is the most well-known, certainly the most in terms of assets, in terms of the number of offerings, Invesco ETFs goes far beyond just QQQ.
And so with that framework, I think that's really helpful info to help people realize why we're doing this webinar with you and Invesco, because there are a lot of ETF companies that offer a wide array of product with a wide array of fundamental approach to the various markets that they're in. But Invesco, frankly, means tech. And it is a huge emphasis for a multi-trillion-dollar organization. And so the comments you're going to be able to offer us today, I think, will be particularly insightful. And we're going to get to the fundamental question of, should tech stay in the port? And if so, how? But at the very core of all of this, technology is all about innovation. Technology stocks lost a lot of money this year, and it's really raising the question among advisors, is there a there any longer? Is this party over? But it really, I think, causes advisors who are looking at the performance of 2022, and advisors are doing this because their clients are calling, with expressions of concern about this, with the outsized losses that have occurred. We take our eye off the ball when it comes to the fact that technology really means innovation. Should we be continuing to care about innovation? Does that still fit in portfolio management? And what do institutions have to say about all of this? So I know that's a big, broad brushstroke, but tackle it from that question. Innovation, attitude going forward, and what are institutions saying?
Yeah, I think, Rick, you and I could probably do 45 minutes on that one alone. So yes, for starters, right, I think you and I have spoken at length on webinars, on podcasts, right, about why we believe that these companies that are listed in QQQ and the NASDAQ 100, which is the index that QQQ tracks, are innovative, right? As a very quick synopsis, what we found is over time, these companies spend more on research and development than peers. Research and development in general is sort of a longer term commitment, right? You don't really see the fruits of that labor next quarter, even next year, right? It's years down the line. What we found is from that higher than average, let's say, R&D spend, we've seen these companies be very active in the patent space across a number of different disruptive technologies, things that are sort of a part of our daily lives today. To give a couple of examples, cloud computing, 3D graphics, big data, stuff that may be forthcoming, human augmentation, spacecraft and satellites, bioinformatics, gene mapping, the list goes on. And from there, we believe that this commitment and sort of diversification of their underlying businesses, as well as commitment to kind of researching these new trends, whether it be trends in technology, consumer habits, et cetera, have enabled these companies to remain pretty nimble and ahead of the curve. Now, ultimately, to your point, Rick, what does that mean? Like that's great that they're pushing the envelope, whatever buzzword you want. Ultimately, from my seat, it's fundamental growth. Right, things like cloud computing, while we've heard about them since about, I think it was we'll call it less than 15 years ago, when it was brought up by the founders of Google as a concept, right? The infrastructure has started to be built. Over the last 5 years, we've seen large-scale technology or technologically adjacent companies, Amazon, Microsoft, et cetera. Those stocks have had a pretty considerable attention placed on their cloud computing businesses, even though we haven't really seen it contribute to the bottom line, except for the past 2 years or so. So that's a very long timeline, and kind of reaffirms the fact that R&D is not really a short-term commitment. It's something that's longer term in nature. But these are the avenues that provide future earnings growth. Right, back 10 years ago, cloud computing was going to drive earnings growth at some point. We're entering that now. Looking forward in 10 years, what is going to be the main driver? I mean, I can look across these disruptive technologies that these companies are in, and it's exceedingly hard to pick the one that's going to hit. But because they're diversified across these themes, like human augmentation or self-driving autos, or again, spacecraft and satellites, you can start to see a bunch of different avenues that could be the next leg, or could serve as the next leg of earnings growth. So technology in general is about growth investing. And when you're looking at something like a QQQ, it's very firmly a large cap growth strategy. So in looking under the hood, it's always important to keep in mind, where are we going to see that next leg of earnings growth? And again, I think in looking at some of the data, there are a number of avenues that could provide that. Did I touch on everything that you asked to start?
Almost.
Okay.
Almost. So that was very helpful. But what I'm wondering is how, we recognize that through the last decade, these growth stocks, these tech stocks, had outsized performance. Whether the companies were making a lot of money or not is one question, but the share prices of their companies were skyrocketing, partly because of the profits they were producing, but partly because of investor expectation of future profits. And now, with this past year and the macroeconomic environment the world is finding itself immersed in, that story has changed, and investors have become far more pessimistic. As we've emerged from the pandemic, everybody's taking the attitude, well, we don't need Peloton because we're not stuck in our houses anymore. And we don't need Netflix for the same reason. And Facebook is shifting to Meta, and Twitter has gone private, and so on and so forth. And it has taken the shine off the stocks, maybe not off the companies, but certainly off the stocks. And it's raising the question, is there still a fundamental investment thesis going forward? And the first question I want to ask you about all that is, what is the institutional attitude about this? What are the pension funds and endowments and hedge funds and big institutional players having to say about all this? What are they doing regarding their tech exposure?
Yeah, so I think as you look throughout the year, you made a very good point on a lot of these larger companies. I mean, it has been pure and simple evaluation sell-off, right? These stocks maybe got a little ahead of their skis. Specifically, the Nasdaq 100 was trading, on a trailing 12-month basis of over 40 on a PE, which is a number we haven't seen in well over a decade. And that kind of went into the summer, right? And we saw a lot of chop in terms of flows. People and institutions use QQQ in a variety of different ways, but ultimately, it can be pretty noisy when you start to look at the data. And QQQ, is largely being used, or is kind of the institutional choice when it comes to Nasdaq 100 exposure. And so you'd see $1 billion in, $1 billion out. You saw 3 billion in one month. You saw 3 billion out another month. And what we've started to see here over the past number of weeks, and certainly over the past month, we've seen some pretty steady inflows. QQQ has taken in about 5.4 billion, give or take, over the past month. To reiterate kind of the choppiness for the year, it's taken in 5.7 billion. Right, so we saw 300 million up through September, and then from September on, we saw 5.4 billion, or excuse me, mid-October on 5.4 billion. So we're starting to see some potential kind of reemergence, right? Folks adding exposure to kind of the large growth space as it's been down At one point in October, 30% for the year. You have, very well-known stocks down over 60% in the portfolio. So you're starting to see some leg in. Beyond that, I think we're starting to see the emergence of QQQM, which is our pure ETF that we launched 2 years ago, NASDAQ 100 exposure, 5 basis points cheaper than QQQ, a little more geared for the retail investor. And we say retail, but really, I think it can be used for institutional long-term investors, because 5 basis points for a long-term investor, that adds up year in and year out. Plus, there are some other components to the ETF structure that we think can be additive to performance over time. That being said, we've seen very steady inflows throughout this volatility to QQQM, and so far year to date we've been just about 3.2 billion in inflows for the year. So we're starting to see people take advantage of volatility when it creeps up. We'll see the flow picture start to accelerate in periods of risk off and certainly selling, but we are starting again, in the institutional side, more QQQ centrics. We're starting to see an acceleration of those inflows into the product. So as of late, I think folks are taking advantage of kind of the discounts that we're seeing in the market. Not to mention, some of the valuation statistics that look much more attractive than say 1 year ago.
So of those inflows, are you able to identify what percentage of it is coming from institutional investors as opposed to retail investors?
We can on a percentage basis. I mean, that's one of the things with ETFs. It is very hard to determine.
Yeah,
exactly
and so
the
reason I'm asking is because I'm wondering where the smart money is. Because what you're describing is not what I would have expected. Frankly, given how poorly tech stocks have performed in 2022, I would have expected that there'd be massive outflows, simply because we know from a behavioral finance perspective that retail investors in particular are notoriously bad investors, that they routinely buy high and sell low, that they love it when the market's at an all-time high, and they fear it when the market's at a low, and talk about an incredible reversal of fortunes from 1 year ago to today. I would have expected there to be massive sell-offs. If you're telling me that you've had net inflows of $5 billion, that says to me that there's a lot of smart money going on here, that astute investors are recognizing if you loved it high, you ought to be totally thrilled low, because it represents a buying opportunity, that the fundamental investment thesis long-term remains intact. So I'm assuming clearly that's what you're seeing here, is that investors are not dissuaded at all by the 2022 performance. They're regarding it as an opportunity to buy in at 2020, 2019 prices.
Yeah, and it really has been exacerbated here over the past month, right? I mean, the lion's share of QQQ inflows can be attributed to what we've seen in the past 30 days, and we had a stellar October when you start to look at equity markets. Before that, it is very sentiment driven, and sentiment is a very hard, very difficult to model or try to forecast. Not to mention, you throw what's going on from a geopolitical standpoint, and then of course what's going on from a macroeconomic standpoint. Everybody hand wringing and trying to dissect Chairman Powell's press conference and what words changed from one to another, right? I mean, it can become a little wishy-washy, and we did see that with the flow picture for some time. But it does seem as though there's a reemergence of interest here, with pretty considerable money coming in by way of inflows. So it does seem like people are regarding it as an opportunity, and certainly with a longer-term view.
And of course, the challenging question is we don't know how low is, so just because we're seeing the inflows doesn't necessarily mean that the market has seen the bottom. And I think there's a general sentiment in the community that we haven't seen the bottom, that we're going to continue to see pressure in the equity markets as the global economic scenario continues to play itself out into Q1, Q2 of next year. The Fed is continuing to raise rates. We still have all of the challenges in Ukraine and with China and with COVID that we have had. We just finished the midterms, and we're going to have new and different Congress going forward. And so I don't think anybody is necessarily excited that from a market timing perspective, this is the time to buy low. I think the general attitude is simply, this is clearly lower than it was. And if you are a long-term investor frequently making investments, this is a better time to invest than it was. And dollar cost averaging always wins out. So if the prices continue to go down, that means you continue to buy. So I guess that's where we're all at with this. I want you to juxtapose this, Ryan, against your peers, your competitors in the marketplace. Invesco is a little bit unusual in the sense that you work predominantly, I would venture to say almost exclusively, with financial advisors, right? You work in the B2B marketplace. You don't really cater to individual retail investors so much. That's not true for a lot of other ETF companies. A lot of other ETF firms and mutual fund companies sell directly to investors. They sell, in the retail marketplace. What's your experience? What's your observations in a combination of your inflows relative to other inflows of other fund companies that are more B2C? Are you noticing a difference? Is Invesco unusual in the sense that you've had 5 billion of net inflows compared to other fund companies, or is this more routine within the entire industry?
Well, I don't know that any year is routine because it changes so much, right? You look at some of the big players this year and some of the woes that they've had in terms of inflows. It's been a challenge. I will say, Invesco has had a pretty strong year following up a very strong year last year. And I do think that, sort of the reliance or the commitment that we have in the smart beta space does differentiate us a little bit, right? We're seeing things like low volatility strategies outperform in a year when you would expect low volatility strategies to outperform. And given that we are pretty well diversified from a factor perspective and sort of an alternatively weighted perspective, I mean, we are a little bit more all weather, I think, versus, let's say a purely market cap weighted shop. So, I think it does really depend as you go down the list of provider to provider. We are seeing a number of ETF firms with tremendous success this year. We're seeing others that are under pressure. I would say on the whole, the industry, however, is continuing to garner assets from various places. I mean, and this is not only a U.S. centric phenomenon. We're seeing it globally. We're seeing a lot of interest in Asia Pac. We're seeing some growing interest in LATAM. Different regions where we're starting to see ETF adoption. Just kind of come into its infancy. So, U.S. of course has been very well documented. The interest in the ETF ecosystem. We're starting to see that spread globally. So, I think broadly the ETF industry has had another very solid year, and looking at Invesco flows, I think we're pretty happy thus far as well.
So, if there isn't a huge amount of differentiation between the B2B and B2C in terms of flows, what about passive versus active? Invesco is one of the champions of passive investing's approach. Your QQQ in particular uses that. How have active funds in the tech sector performed this year against the NASDAQ 100 index?
So, I think it's definitely an interesting paradigm when you start to look at the purely active space versus the right. I mean, this is a debate that's raged here for well over a decade. And, I think when you're looking short term, like the large growth space has performed pretty well against QQQ. And I think as you start to look longer term, it has not done very well against QQQ. And, year to date, let's say QQQ through the end of October was down near 30%, 29.74%, and that's good enough for 58th percentile in the world of large growth funds. The peer group medium median, excuse me, slightly better, down 29.12%. But as you start to look longer and longer term, 1 year out, QQQ is the 45th percentile in large growth. 3 year, it's in the 6th percentile. 5 year, the 4th percentile. You go all the way out to the 20 year, it's in the 1st percentile. So the longer term you look, the harder it is, or historically, the harder it's been for large cap growth funds to beat QQQ, and this is an aggregation of both mutual funds and ETFs. As you start to look at kind of the blend space, a similar picture, although because of just the vast outperformance of value this year, you look at QQQ against most blend funds, you're in the 99th percentile. But again, as you start to go out into the 3 year, the 5 year, again the 20 year, in the 20 year it would have been the number one ranked ETF mutual fund out of over 700 in the blend space. So shorter term, with all this volatility that we've seen this year, we've seen a little bit. We've seen active managers do better than historically against QQQ. I think an interesting statistic, and one that's maybe more conversational, is just you don't really see a ton of large cap growth managers benchmark against the Nasdaq 100. And I think if you're going out against Russell 1000 growth and performance over those timeframes, frankly, it's an index that's maybe a little easier to beat. Now, NASDAQ 100 is a very concentrated basket of 100 stocks. You start to look, it can be very top heavy. That top heavy nature has served it very well over the past 20 years, certainly over the last 10 years, and has hurt it this year as we look at performance. So it is a double-edged sword, but you can see with a more concentrated basket of 100 names, why it would be harder to beat, and why we don't see as many active managers benchmark against it.
Yeah, I think that this commentary of active versus passive, as you said, is a very active debate and has been going on for decades, and it's going to continue. And I don't think anything that you or I might say is going to persuade anybody to change their point of view on this. It is a style management issue. It is a practice management issue. It's a marketing issue. It's a firm culture issue. And advisors are going to decide how they feel about it. And that's kind of all there is to it. There's no reason to really belabor the point as to whether I'm right or you're wrong. I think my point of view is, at the end of the day, we're both directionally going to be correct. I think it's more important that we are invested rather than we are deciding what we are invested in. It's the market timing versus the long term that I think is frankly more impactful. And you just have to decide what your selling points are to your client and your rationalization and justification for the positioning that you're dealing with. The fact that you have the data on your side speaks very well to the argument as to why investors ought to be using the Qs and the approach that Invesco offers. But like I said, nobody's position is going to be persuaded one way or the other in this webinar.
No, and it doesn't always fit in a neatly packaged box, right? We talk about performance. There's a lot more from a risk-adjusted standpoint that, as you start to look under the hood, there are vast considerations for a vast number of clients, and no two are going to be equal. So to your point, I think we won't solve that debate on this call, nor I think any call in the future.
One aspect of tech, that is worth describing in QQQ, and you mentioned the NASDAQ 100. The QQQ is not really the NASDAQ 100. It is the NASDAQ 100 minus banks, right?
So the NASDAQ 100 is defined as, let's put it this way, it is not the 100 largest. From a methodology standpoint, the NASDAQ 100 is made up of the 100 largest companies listed on NASDAQ exchange, ex financials. Now, we don't really see a number of financials that list on NASDAQ, right? I think if you start to go through most of the major banks, most of the major insurance companies, most of the largest financials, they're listed on the New York Stock Exchange. Now, if we turn the clock back to 1985, when the NASDAQ 100 was launched, they were also launching at that time the NASDAQ Financials Index. And, I think you and I have talked on webinars. we joke it's better to be lucky than good sometimes, because right, that's the reason as to why there's no financials within the portfolio. So what you start to see from just looking under the hood at the exposure, right? I think going back to the late 90s, early 2000s, it was overwhelmingly technology. And since then we've started to see a moderation of the pure technology exposure within the portfolio, but it largely leans to the growth side of the equation with consumer discretionary names, with communication services names like Meta and Alphabet, and then beyond that, some of the healthcare that's differentiated more on the bioscience side of things and or medical device side of things. That's all driven by the types of companies that historically have listed on NASDAQ. Ultimately, that's the qualification to be included in the NASDAQ 100, and then by extension, QQQ. I mean, you have to be listed on NASDAQ. You have to be one of the 100 largest companies listed there, and you can't be a financial. So the question becomes, well, how does this exchange continue to attract these very growth oriented, technologically driven, however you want to describe it, companies? And I think ultimately, you look back through its history, NASDAQ is sort of the first electronic exchange, right? They talk about some of the data capabilities, and the question that I always talk about is, what do you want to be when you grow up? If I'm a smaller tech company and I see, well, Apple and Microsoft and Amazon or Tesla are listed, that's, you kind of get a gravitation of these companies to list on NASDAQ, because you have these sort of growth leaders or companies that you might look up to as a young burgeoning technology company. So that's why there's a long-winded answer as to why there's no financials within the NASDAQ 100, and then by extension QQQ.
And you had mentioned QQQM and the fact that is an ETF. QQQ is not structured as an ETF. Somebody who's watching this today heard your interview with me on my radio show a few weeks ago, where we were talking about this, and you had referenced the QQQ Innovation Suite. And they've asked a question of elaboration on that, because I think this is a big deal within Invesco circles. Invesco takes a lot of pride in its innovation suite, but I think there's a little confusion among advisors as to exactly what that is. And, because you have not just QQQ and QQQM, you have a variety of investment products that are, I'll call them derivatives of QQQ. They are variations. So let's take a moment and elaborate on this, because I think this is worthwhile for advisors who are watching this.
Yeah, and that's a very good way to describe it, right? Like kind of loosely related to one another. Maybe a public service announcement. If you have an aversion to the letter Q, mute your computer now, because there's a lot of them forthcoming. QQQ is sort of this is the baseline for all of this, and this was launched back in 1999. And as Rick had said, it's it's a unit investment trust. Nothing weird about it, I like to say. That was just a more popular structure back in the 90s, and and the largest ETF out there, SPY, which tracks the S&P 500, is also a unit trust. It enjoys a lot of the benefits of ETFs, like trading, intraday liquidity, transparency, their creation redemption process, but there are some nuanced differences in structure that we believe is more geared for the retail investor, going to the ETF structure. So we launched QQQM, which is also tracking the NASDAQ 100. If you look at the two funds next to one another, you'll see the same holdings and the same percentages. But QQQM is an ETF. So for starters, like I said, it's 5 basis points cheaper, 15 basis points of expense ratio versus 20 for QQQ. And some of the other benefits would be the ability of the portfolio manager to reinvest dividends. Now, this is at the fund level. So an example would be, as Apple pays its dividend in QQQ, the portfolio management team needs to hold that dividend in cash off to the side until QQQ's declared distribution, in which case it takes that cash and distributes out. Within QQQM, the PM team can take that cash, reinvest it back into the index to try to mitigate some of the cash drag that exists in holding a bucket of cash in a fully invested ETF. So in up markets, you can expect, an added basis point or two of performance because of that reinvestment. Similarly, they're able to engage in a securities lending program. So just lending out shares of the companies that we have to folks that are looking to short sell, of course, for a fee, in which case we take that fee as more revenue for the fund and can also help aid in performance. And then the last difference between the two, QQQM, again, being more geared towards the retail buy and hold investor, maybe the self-directed investor, it's offered at a lower NAV when compared to QQQ. So that's why we look at sort of QQQ as being the choice for the institutionally geared investor, one that may rely on secondary liquidity or different derivatives when trading it, whereas QQQM, it would be our choice for the buy and hold long-term investor. With QQQM, we also launched QQQJ, which is tracking the NASDAQ Next Generation Index. We talked about how the NASDAQ 100 is the 100 largest companies listed on NASDAQ X financials. The next generation is the 100 companies just below that. So the thought here is getting some of these companies, these growth-oriented companies, maybe when they're still in mid-cap, right, and an earlier stage of their growth cycle, and investing there, riding the wave higher until they get called up into the big leagues, or the NASDAQ 100, but no overlap between QQQM, QQQ, and then QQQJ. So NASDAQ 100, NASDAQ Next Gen, you won't see overlap between the indices. Same rebalance, same reconstitution schedule. So they're meant to be used as a suite, a very complementary basket of strategies to kind of go beyond the just the traditional large cap growth side, but to introduce some mid cap growth. Catch my breath. Then in 2021, we launched QQMG and QQJG. Quite simply, they're looking at the NASDAQ 100 and NASDAQ Next Generation indices through an ESG lens. So, traditionally, if you look at QQQ or the NASDAQ 100 and NASDAQ Next Gen, they're fairly ESG friendly indices to begin with. But NASDAQ and us, we partnered with Sustainalytics to run those indices through separate ESG metrics, which we will use to reweight those indices. And for those clients with an ESG mandate, or a client that may be wanting to express an ESG view, we offer access to those indices through that ESG lens. That suite, or those two funds, it's really all about choice. And then lastly, just about a month ago, we launched the newest addition to the family, QQQS, which is the Future Gen 200. So, when we launched the next generation, the questions obviously came flooding in. Well, when's the next gen, or the next gen? Like how many steps down will you continue to move? And this is one that takes a little bit more of like a thoughtful approach to rounding out small cap exposure, because the NASDAQ composite has well over 3,000 companies that are members, and as you start to go down in market cap, the names start to look a little bit varied, right? You get a little bit more exposure to, let's call them non-innovative sectors, right? You get some utilities exposure in there, and the like. And within that, right, I think the small cap universe, it is rather varied, and rather than just kind of moving down in market cap tranches, we wanted to introduce something that we look at very frequently for the NASDAQ 100 and Next Gen, and that's this notion of patents. So effectively, QQQS is investing in 200 stocks with the highest patent value per market cap ratio, where basically we're trying to give you patent value for your buck, or underappreciated patent values within these smaller cap names. And with that same sort of ethos of giving exposure to very innovative names, we're using a metric, a data point, in this case patent value, to try to identify those companies that may continue to innovate and push that envelope, and who knows, maybe even jump up into the NASDAQ Next Gen or NASDAQ 100. So
So
I'll catch
you,
my breath there.
well, that's quite an answer. Thank you. That was very clear. Within that, you often refer to the fact that Invesco pays a lot of attention to patents. Not many other firms do. It's certainly not a word that is frequently spoken by advisors to their clients. Your attitude is that the patent filings lead to R&D, which lead to new product, which leads to sales, which leads to market share, which leads to profits from advanced revenue. So it all starts with the patent. It's called like a leading indicator, I would say. The more patents a company's issuing, the more you have an idea of what their future is going to look like. You pay a lot of attention to patents. And how is it you determine who's filing a lot of patents?
Yeah, so just a quick clarification. I think it's sort of like it's driven at first by R&D, which then potentially leads to patents. But I think you hit the nail on your head. I mean, a patent can be a leading indicator, right? It can represent a competitive advantage, and being that it's an exclusive right for a potential or an exclusive right granted for an invention, right? It represents a new way of doing something or a new solution to an existing problem, et cetera. And I think that inherently kind of represents that competitive advantage. NASDAQ is partnered with a company called IPR Strategies. They have a based out of Europe, well over 20 years of research into patent valuation, a number of different clients, right? Unsurprisingly, when looking at the M&A world, right, as we're looking at acquisitions of either companies with patent portfolios, or in many cases, you'll see acquisitions of just a company's patent portfolio. They've developed a patent valuation system that's used in many M&A deals. It's used by various governments and research institutions in looking at the M&A space. And they look at sort of what that patent can deliver. Right? How much influence can the holder of the patent exert? What sort of basis across markets will it have? What kind of attractiveness will that patent determine? The quality and legal aspects that also exist, right? How long? How from an age of a patent standpoint, excuse me, are they still young? Did they get that patent protection already granted? Is it still in the early stages of that? So, I mean, there's a lot of different nuance when looking at and evaluating patents. But IPR has, in their 20 years of working with all these different clients, developed an algorithm that helps to value individual companies' patent families and, by extension, their overall patent portfolios.
And that is one of the questions we just got from one of our attendees: is how do you calculate the value of a patent? So that was a really good answer. To what degree is that patent calculation impacting the decision to include companies in the fund or not? Is it the sole criteria, or is it one of many?
It's a very large reason to include something. I mean, the other step is patents to market cap, right? So it's almost, if you think of it, it's almost like an underappreciated patent value in the marketplace. There are companies that are out there that have very expansive patent portfolios, and that their market cap may reflect that already. I think what we're looking to do with NASDAQ and IPR in this index is to look at those companies that either it hasn't been fully appreciated, the visibility into the patents is not appreciated, or maybe it's just been somewhat forgotten, and there's some value to be had because of a mispricing of let's say the stock price. So I think there's different ways.
It just strikes me as very logical that if you're trying to identify the growth leaders of tech for the coming decade, that you would look at the patent data, because that there's so many struggles in deciding who's got a business that's going to succeed. The patents, I think it does make a lot of sense that that's going to give you some indication. There's a whole lot of other business issues, execution risk, market risk, regulation risk, et cetera, consumer adoption risk. But still, it all begins, like you said, with the patent. So that and the R&D function, that makes an awful lot of sense. And this might be related. Daryl, one of our attendees, is asking, and you may have addressed it with your description of the various ETFs in the innovation suite. Are any of the Q funds focusing on U.S. small value or international small value in particular?
No, so not at the moment. I think when you're looking at sort of NASDAQ listed companies, the vast majority of them are US based. So nothing from an innovation standpoint that is looking internationally or on the value side. What we found in looking at the back test of QQQS or the innovators completion cap index as the NASDAQ index that QQQS tracks is it can move around a bit, right? It in some cases it will score closer to value than you would expect. I think again that's a function of patent value to market cap, and I wouldn't say that it's something that you would expect. I would say that most of the time it is going to be leaning towards the growth side of the equation. But because of utilizing that data point, something other than market cap, you can see kind of value scoring show up. But ultimately, a long-winded answer to say no, there's not an international or small value component to our ETFs in the innovation suite.
And this is another question we got from Kyle. I'm just doing the math in my head. Am I right that the Qs collectively represent what, 250 million or billion of total assets at Invesco? Is that about right? Is it bigger?
We're probably a little under. Let's call it, we'll call it maybe 170.
Okay.
At one point we were probably around 220.
Yeah, I'm thinking a year ago numbers. You're exactly
right.
So 170 billion. This is out of 1.3 trillion in assets. So you're talking a little better than 10% of the assets of Invesco are in the Qs. Can you tell us, this is what Kyle's asking, about some of the other products?
Sure. Well, I think as we start to look at the ETF side, which that's kind of the world that I largely live in. RSP, which is the S&P 500 equal weight fund, is probably the one that's most notable. Very easy to understand. You take all constituents of the S&P 500 and you give them an equal weight. Beyond that, I think our single factor suite is very robust. We have ETFs that look at low volatility, that look at momentum, that look at pure value, but really kind of digging in and utilizing metrics to really get a very small subset of the broader index. In this case, like in the large cap world, the S&P 500, to give very deep and robust factor exposure. We have dynamic multi-factor ETFs that are truly kind of a go-between between pure passive and active, very quant driven in that the fund itself will move around depending on what economic regime the signal indicates. So it a lot of turnover, but again, it will move around, and something that is maybe a little bit unique to Invesco. And then from there, our active management suite, we have SMAs, we have global real estate, a very well-known emerging markets business. And we know, I said early on the call, a very well diversified asset manager. I believe that we do have significant assets across these scope of strategies and looking to build upon where clients' needs are going next. So you're seeing a lot of investment in sort of the private space and various other strategies.
One of the things we really can't avoid talking about, given what's happening in the last week and a half pertaining to FTX. In the field of technology, and you run through a litany of different areas of expo tech, AI and robotics, 3D printing, nanotech, biotech, bioinformatics. You launched into a bunch of those names. Everybody knows I'm a big fan of exponential technologies. That was my last book, The Truth About Your Future, which is a description of all of those. And blockchain and digital assets clearly are on that list. And in the last week and a half, we've seen the implosion of FTX. The fallout is still being revealed as we sit here today, and this story is going to last for months and months. Have you seen in the kind of investments that you're focusing on, for example, within the QQQs, has there been any contagion? Has the FTX debacle had any impact on the Qs?
Not directly. I mean, I think, from a sentiment perspective, right? I mean, this certainly gives pause, right? I think it gives investors worry. Early on when we were discussing kind of Qs and digital assets, we always described Qs as sort of like adjacent, right? I mean, there was some patent activity across blockchain, across digital assets, across mobile payments, things that are on the fringe of kind of the digital asset ecosystem. But I haven't seen any sort of direct impact other than sentiment. In calls from clients, it hasn't really been brought up. In looking at comments from company executives, I haven't seen a ton that would determine contagion. And then as you start to look down the list, whether it be through kind of where assets are held or some of those other metrics, it doesn't seem to be something that's a direct concern at this moment.
And that's a savings grace in this debacle. But it does tell us that at the moment, at least, or to date, over the 14-year history of crypto, that it is not yet rising to the level of permeating throughout the broad equities marketplace. So this FTX issue, which is a big deal in crypto, is only a big deal in crypto. And it isn't affecting the broader array of the tech equities marketplace. So I guess that's something to be thankful for in all of this mess. And speaking of that, there are big name companies involved in the crypto space. IBM, for example, is well known for its big blockchain business. NVIDIA, the huge chip manufacturer, makes chips that are used by Bitcoin miners, and so on. There are a bunch of, if you ask people to name, give me the name of companies you've ever heard of, they'll mention household names, and those are all big companies. The Fortune 500, the S&P 500. But there are thousands of small companies in the U.S. as well. But investors tend to ignore them, don't they? We've had the question about small cap stocks. Investors tend to ignore those.
Yeah, even from a valuation standpoint, it's something that my team talks about pretty frequently. I mean, you've seen small caps hold up pretty well relative to large caps. You didn't really see necessarily the same level of outsized valuations that we saw 1 year ago. And I think there's always value to be had and value to be found as you start to look down in market cap. And of course, reasonings, whether it be if we're close to a bottom and we start to see a reacceleration of economic activity, whether that's Q1, Q2, Q3 of next year. I think that there's a lot of reason to take a look at the small cap space. And those small caps, we can go through previous iterations of portfolios, and you look 10 years ago, I think you'd be shocked at some of the large caps that once were small caps.
I think you're absolutely right about that. There's such an array of product that Invesco offers, and such array of services and research and materials and sales support that Invesco provides to advisors, which really, I think, is one of the things that sets it apart. I will mention, speaking of FTX, that we just did a webinar this past Friday on the FTX saga as the news broke, and you can watch that webinar at DACFP. You can download the replay of it, view it online. Just go to dacfp.com. We've got a minute or two left, Ryan. Tell us, how can advisors, on behalf of their investor clients, implement Invesco's ETFs within their portfolios?
Sure. Well, I truly believe, there's something for everyone, right? And we had talked about it in the active passive debate. it's going to depend client to client what the end goal, what the long-term goal there is. But I think for the purposes of most of the funds that we've spoken about today, I think you can very easily implement these as a suite, using either QQQ or QQQM for your large growth exposure, QQQJ for mid-cap growth exposure, or and then QQQS rounding out your small cap growth exposure. I think you can make the argument that you sort of get exposure to underlying themes if you do look at the markets through a thematic lens. That's really being driven by a lot of the patent activity and some of the underlying businesses that these companies have diversified into. But the funds that we've spoken about today, I think firmly belong on the growth side of the equation. And if there is small value that you're looking to implement, if there's mid-cap, low volatility, chances are Invesco has an ETF for it. So just reach out to your advisor consultant, who will kind of come to my team or some of my teammates, and we're happy to jump on a call or kind of explain, educate how it fits and the differentiation of each and every one of those funds.
I certainly hope everybody does take advantage of that. You can reach Invesco, of course, at Invesco.com. This has been a great conversation, Ryan. Thank you very much for this. We put into the chat the link to the FTX webinar if you would like to take a look at that and make sure you're conversational with your clients. I also want to tell you of our next webinar that is coming up on December 6th, just a couple of weeks. What to consider when contemplating crypto for client portfolios, despite what's going on with the FTX saga. We are continuing our education for you, and this webinar series is all part of that. Paul Ma and Darby Nielsen from Fidelity will be joining us for that conversation. We also want to encourage you to get your certificate in blockchain and digital assets. This is an online self-study course, 13 CE credits with a world-class faculty. The first half of the course is all about the tech. What is Bitcoin? What is blockchain? How does it all work? The second half, all about practice management. What's the investment thesis, the investment opportunities? How do you build a portfolio? All about regulation, taxation, operations, and compliance and risk. And most importantly, how do you talk to your clients about crypto, especially in light of what's happening in the world of crypto these days? It's very inexpensive to go through this course. The price is rising. It's only $679 right now, but the price is rising January 1. So enroll today, take your time completing it, but secure that low price today. You can register and enroll at dacfp.com. And I encourage you to pick up a copy of my newest book, number one Amazon bestseller, and also just won an award from the Society of Business Journalists as one of the best business books of the year. And my radio show starting in January is going to podcast, a weekday podcast. You can subscribe at the TAFEayf.com, thetruthayf.com, the truth about your future, and make sure you're getting my daily podcast. And if you have any questions, want to reach me directly, here's how you can do it. No matter where you are on social media, you can reach me, including direct emails, rick@dacfp.com. Thanks again for joining me on the program today. Look forward to seeing you at our next webinar. Let us know how we can help between now and then. Thanks. Have a great day.